Before we get into the financing for SMEs, let us understand the definition of SME. These definitions differ from country to country. As per the SME policy framework developed by the Ministry of Industries of Sri Lanka in 2017, SMEs are defined as any business entity or enterprise which has less than 300 permanent employees and has an annual turnover less than Rs 750 million. SMEs play a major role in economic development of a country and are identified in most countries as the backbone of their economy. In the SME category in Sri Lanka, it varies from well-established and structured company to extremely small-scale operations with individuals running with 1 or 2 employees. In this video, we are aiming to focus on some key elements related to financing for SMEs. It is good to set the context of how SMEs' financing requirements are unique compared to large corporates. One must understand the following distinctive points relating to SMEs. Number 1. There is lack of formality in approach to work, which is overlap between owner's personal income, expenses, asset and liabilities with the business. This also caused by lack of understanding of the importance of proper financial reporting and auditing. Number 2, heavy reliance on one individual or owner to run the show. Number 3, lack of awareness to manage the working capital needs and weak focus on cash, debtor and creditor management. Number 4, reliance on self-funding the business or relying on informal sources to keep the business afloat. This causes SME to take on loans with higher borrowing rates and unfavorable repayment terms. SMEs should try to strengthen these areas to improve their businesses and develop resilience to face challenging times such as ongoing pandemic. SMEs are always exposed to various changes in the external environment, and therefore they need a sharp focus on working capital and day-to-day cash management. Remember, working capital is considered as the lifeblood of any business, where the company should be fully focused on its priorities. Any slight disruption to working capital could lead to a failure of the business. Also, it is important to understand most SMEs operates with very thin profits margins, and therefore any increase in cost of production could erode their profits as well as their capital. Therefore, SMEs should keep in mind that they need consistent financing provided by credible sources to support operations at all times. Accessing affordable finance for SMEs is always challenging due to several reasons. As highlighted before, it is important to maintain a proper set of accounts to assess the profitability and financial position of a SME clearly. It is also important to understand the role of creditworthiness plays in obtaining finance for SMEs. Certain SMEs may avoid maintaining proper financials due to the fear of paying taxes. However, this makes it difficult for financial institutes to assess the creditworthiness of the company. Financial institutions are under strict regulation of the central bank, as they are operating with general public's deposits. Hence, when lending, unless SMEs establish their creditworthiness and the repayment ability, formal institutions cannot lend freely. The lack of assets to be used as security for loans, commonly known as collaterals, also make it difficult for SMEs to access to finance. This has resulted in financial institutions becoming further careful and restrictive in lending. When SMEs are unable to seek facilities from formal institutions like banks and registered finance companies, they have no option but to seek support from informal sectors at unaffordable interest rates and credit terms, which is severely affecting their business growth. Finally, this can lead to deep deterioration of their income and profitability. Therefore, remember, maintaining financial records is important for an SME. These financial records need not to be perfect. It could be simple recording of income, expenditure, assets and liabilities, which will go a long way. Additionally, every SME should have a clear, written business plan for themselves, as this will help them to obtain financial support from a formal financial institution. SMEs should always have a basic understanding of bank facilities and various types of loans that are available for them. In this context, SMEs should know their requirement in advance to decide whether they need short, medium or long-term facility. The golden rule here is that short-term facilities should be used for short-term use. Payment of salaries, utility bills, finance a supplier should be done by using facilities such as bank overdraft or short-term loans. The medium-term requirements such as purchasing a vehicle or soft machinery should be backed by a medium-term financing arrangement such as a finance lease or a term loan. Finally, long-term requirements such as investment in land, building or heavy machinery should be financed through long-term loans or owner's capital, normally we call as equity. At the same time, it is crucial that SMEs critically evaluate their debt service ability, as high debt levels would be detrimental to the sustainability of any business. In addition, gearing, which means the debt to equity ratio, should always be maintained at healthy levels. In conclusion, these are a handful of business tips in exploring financing for SMEs. However, in any complex situation, businesses should obtain expert advice accordingly to specific requirement. The focus of this video to help businesses to structure themselves for long-term continuity of their business and seek professional advice for their individual financing requirements.